Hello, and welcome to Nutmeg's Investor Update for May. I'm Kira Stacey, People Manager here at Nutmeg, which means I look after all things people related. This month, I'm particularly excited about our upcoming crowdfund, which is all about bringing Nutmeg customers closer to everything we do here and starting a brand new community. You can find out more and sign up for updates at nutmeg.com/crowdfund. Now on to this month's Investor Update. I'm joined by Shaun Port, Chief Investment Officer. Hi, Shaun.
Hi, Kira.
How did the markets fare in April?
Well, Kira, it felt like a really kind of subdued month, that not much was going on in April. But if you look at the returns of stock markets, generally they were pretty strong. In emerging markets, about a third of markets lost money, but overall emerging markets returned about 2%. In developed markets, there was quite a wide dispersion of returns, ranging from -1%, which was Finland, up to +6%. Now, within the major markets, the laggards really were Australia and Hong Kong, returning around 1%, the UK and Japan returning about 2%. If we look at the stronger performers, that was France, almost 5%, and Germany and Sweden both returned over 6%. So particularly strong returns coming from Europe, which is interesting in the context of the European economy performing still quite poorly at the moment. Outside of equities, bonds had a relatively tough month. So government bonds lost money in the US, and in the UK here they lost 1.6%. So quite a big loss from government bonds. And property also had a tough month. So global property securities lost almost 1.5%. So equities themselves had some really quite strong returns, but outside of that, returns were far less impressive.
So what was the driving force of that good return from developed markets?
If you look at economic performance, it actually wasn't economic performance that really was driving markets in April. Actually, in Germany and South Korea, the picture still looks particularly weak. There was some small improvement in the Chinese economic data last month. The US continues to be pretty strong, so we're seeing 3% growth in the first quarter of this year. So the US is doing well, but everything else is a bit mixed. So it really wasn't the economic data that had improved that helped markets. The main driver really was that company earnings, particularly in the US, were really quite strong. If you go back to the end of last year, people were worrying that the earnings coming through is likely to be very weak at the beginning of this year, and that hasn't been the case. So of half the companies that reported so far in the US out of the big 500 companies, almost 80% have beat expectations. So some really good numbers coming through from companies, and actually particularly in the tech sector. Apart from Google, we've had some really strong company earnings from the tech sector, and that's powered the US market and tech stocks in particular to all-time highs. Now, we shouldn't worry that markets are at all-time highs. This is really a feature of what happens when markets are going up. You know, typically when a market is in an up phase, you would see the market stay a lot of the time close to an all-time high. So this is quite a normal thing, quite a normal feature of markets going up.
So, Shaun, how have the markets received the news that Theresa May has had an extension on Brexit until 31st of October?
It's funny, this feels like a long time ago now, I think, and that's the sentiment in the market. Really, Brexit has dropped off the radar of global investors. If you went back a month ago, 2 months ago, this was cited as a big risk to markets. Whether you're a US investor or a Japanese investor, the UK crashing out of the EU without a deal was considered to be a very big systemic financial issue that investors should be concerned about. And now that's been moved potentially to October the 31st. That's really become off the radar. So for us, I think what's going to be interesting is that when what we believe political tension will start to rise, given the European elections at the end of May, I think we'll start to see a bit more volatility in the pound. But for global investors, this has become much less of an issue. I think the biggest issue is really still around trade tension between the US and China, and potentially that shifting between the US and Europe.
Given all that, how did Nutmeg's fully managed portfolios perform in April?
So low-risk portfolios delivered around a 1% return. Obviously, a lot of that came from the rise in global stock markets, but we felt less of an impact from the fall in UK government bond prices, given that we've been quite defensive in the way of managing our bond components within portfolios. Medium risk portfolios delivered around 1.75% during the month, while the highest risk portfolios returned around 3%. So our holdings in emerging markets and Japan were a bit of the detractors, I suppose, the lower performers during the month, but a lot of the gains came from US stocks, particularly US tech stocks.
This month's customer question comes from Phil on Facebook. He asks, to cement your position as a leader in eco-friendly investments, will you be making SRI portfolios the default for customers?
I think it's important customers have that choice between a managed portfolio and a socially responsible portfolio. And we've already seen a really big take-up already. So almost 5,000 socially responsible pots have been set up since November. So it's important that customers have that choice, but they are also making that choice. But what I would say is that we've made a significant commitment by signing up to the United Nations Principles for Responsible Investing, and one of the few wealth managers here in the UK that have done so. And as part of that commitment, with embedding environmental, social and governance factor analysis into our entire investment process, not just for our socially responsible portfolios. And that's because we believe that these factors will have an increasing bearing on the future returns from investment markets. Already last year we saw that an environmental disaster caused one of the largest corporate bankruptcies in US history. So these factors will become an increasing important part in the performance of markets. Now we do expect the industry to have a very big shift towards this, but it may take 5 years or longer. But for us, that change is happening now.
Thanks, Shaun.
Thanks, Kira.
Thank you for joining us. As always, if you have any questions for Shaun, feel free to drop us an email, contact us via social media or in the comments section. See you next month.